Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly whirlwind through all the latest news and happenings in the mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host, and this week back in the co-pilot seat for at least the third or fourth time, one of our favorite TMC guys, the VP of Operations for VIP Mortgage out of balmy Arizona, Mike Metz.
Hello, everybody.
Mike, good to see you. And thanks for coming back and doing this once again. Always really enjoy getting your insight on the industry. And we're off to kind of a weird start, really, to 2022. And, you go back to a year ago, I always like to do that. And when we were in the middle of January, it was kind of like, man, wow, this year is off to a busier start than I thought. And it was the foreshadowing of what was a much busier year than any of us thought. And what will likely come in is the second biggest year in the history of the mortgage industry. But fast forward to today, and it's been a goofy start, fueled largely by, intensified inflationary fears. The Fed has kind of ramped up their rhetoric. The market has kind of priced in more aggressive Fed actions for this year. As a result, we've seen 30-year fixed rates go to their highest levels in a couple of years. We're, correct me if I'm wrong, mid to high threes, depending on best credits, probably about 3.5. And which obviously has had the obvious impact on refinance business, and still some impediments, obviously, to the purchase market as well, all really funneling around affordability, which is not helped by higher interest rates, and inventory. Just been a number of different indicators that have come out these last few weeks that continue to verify that demand for new homes is strong. But that the supply side still is constrained and has some challenges. You're in what your friend Katie Klaus likes to call the poster children of potential bubbling in Arizona. But I would just, appreciate your perspective on inventory, the goofy start to the year, and where we're at as we get into 2022 here.
Like Katie mentioned, we're in particularly interesting territory for that just because our migration numbers inbound are just still so high. So even with our builders building from our perspectives in the middle of nowhere, and you wonder who's buying these homes. I was reading that we still had something like a 38% increase in migration numbers for us this year. And it just has our inventory starting from low and going even lower. And then we still are not seeing enough inventory, especially for the first-time home buyer market. So that's just flying up. But I hear that one is pretty consistent all across the board in the country right now. Is no one can find places to rent, no one can find places to buy, especially for a first-time home buyer. So it does make for a very interesting purchase market to start the year with.
Yeah, and it's, like you just mentioned, having the obvious impact on rents. People that are renting properties know that people are looking for affordable homes to buy and can't, and rents continue to rise as well across America. If you just look at inflation in general, housing related components of inflation are driving a large part of it. And it's kind of the self-fulfilling prophecy that inflation is driving interest rates higher. Interest rates are driving affordability higher, and it's continuing to have the negative impact on inflation. And you mentioned, like, people got to be very eager to build new homes out in Arizona and other really emerging parts of the country. But another added impediment is, you see now, lumber prices again kind of flying through the roof. I just saw a few hours ago the National Association of Home Builders, and we just got confirmation their CEO Jerry Howard will be speaking at our TMC conference coming up here in Miami. It'd be very interesting to have the CEO of the National Association of Home Builders. Their home builder confidence index fell this most recent month for the first time after rising slightly for 4 months. So a lot of goofy impediments to the supply and inventory side of the business.
And one thing that I feel like is going to, and I haven't seen any articles on it yet, but I'd love to see the numbers on how the inflation is going to change that even further. I mean, it's obvious with the builders and lumber prices and I mean, the supply chain stuff, but then my logical thinking is if you've got inflation and it's getting more expensive just to live, you don't see wages increasing at that same rate. If you're someone who's already now worried about affordability, that's not going to be the time you're normally going to move up. And I feel like that's the main time you see houses go on the market as the family's going through either the sad case where there's a death and they're downsizing or the divorce situation, or they're moving on up. And we don't have this giant population growth spike. And if you're worried about affordability, you're not going to just buy a larger house because you're making more money. So to me, that would cause the supply to go down even more from what you've already got from the builders decreased building. So that's where I'll be interested to see if there's any stats that come out on that. But it does have me concerned on that front.
Yeah, I just had family over this weekend, and my aunt, she was, talking to me about just housing, and they own like a, $330,000 value now house in Northeast Ohio, and they're like, married, no kids, like semi-retired, and they're ready to move up. And they realize that the home that they bought for whatever 220 or 230 that they thought would be worth 300 now, that's worth 330 or 340. They got a little extra juice there, but the home they want to move into is inflated by multiples higher than that, and they're leery. So it really kind of brought it home to me, these things that we're talking about when you talk to people and see it. So with all that as a backdrop, and the higher rates and supply constraint and other factors, how do you look at just this year? If you look at the projections, most call for total volume to be down about a third. Refis to drop off pretty significantly, but purchases still to be up 7 to 10%. I know you guys at VIP are always moving and shaking and growing, but like independent of that, like the same originators that you have on staff right now, do you see purchase activity being 7 to 10% higher this year? And maybe it would be because, you guys are national, but I would imagine you're doing a lot of your business in what would be considered emerging markets.
We're still heavily in the Southwest, and we do have some business elsewhere, but that's one where my personal thought is if you kind of look at it nationwide, I think you'll have some markets where they do hit that increase of 7%, but there's a lot of markets where I worry those forecasts are going to end up wrong, and you'll have purchases probably, I think an optimistic view would be flat, just because I don't think the supply issue is going to get fixed. And I think as you get more inflationary concerns and you get the Fed then increasing rates even more, affordability goes down. I personally believe that if you take a look at most of the numbers in 2021, we've already maxed out that demand. You already saw the crazy frenzy market. So that's not really going to go up much higher. The new build rates, they are what they are. And it's not like they can just magically get homes built tomorrow, even if they didn't have supply problems, both in cost and availability. So if you still have the big funds that are buying up these homes to rent them out, I don't think you're going to see more supply becoming available, more people looking for a reason to sell. I think that supply is going to go down, which is then going to cause our purchase numbers to go down a bit. So the optimist in me hopes that I'm wrong on that one and that we do see that increase in purchase business that I've seen multiple places, but I don't logically see how that can still be accurate by this point.
I agree with you. I hope we're both wrong. My guess and my hope is that we're going to see something from the federal government at some point soon related to trying to help fix the supply issue with housing in America. I would have hoped that we would have seen something by now, but I think a couple things. One, lumber is now again in the headlines, right? So that catches the eyes of politicians and Joe American and writes into their representatives, or, the couple that wants to build a home and can't. Also, the shelter, as mentioned previously, the shelter related components of the inflation reports continue to rise and continue to be a bigger part of the CPI numbers and and then I go back to, we both heard Sandra Thompson at our conference in September. Like she clearly acknowledged that, she said it in a couple different ways. Like, we could do a lot of great things in terms of restructuring of Fannie and Freddie programs and doing things to help more, disenfranchised want to be home buyers. but it all doesn't really mean anything if we don't have affordable home supply for them to buy. So I'm hoping that with all that as a backdrop, that we see something from the federal government, some ideas that I've thrown out that I think could work is, one is some sort of incentive for individual people, not in corporations, that own investment properties to sell them, some sort of tax or capital gains tax waiver or reduction, or restricting investors and corporations from buying these big blocks of homes that they turn around and resell or rent. Think I'm crazy? Am I being too optimistic about our government?
I think you may be optimistic about the speed in which they can actually roll those kinds of things out. I think those are all very good ideas to help. I think the government willingness to try to do something is there. I think we've already started to see with FHFA announcing those changes to the LLPAs in second homes, and especially that high balance of them kind of saying, you know what, let's focus our vision more. And I think they're going to focus more on trying to get that home ownership going and focus more on those. So kind of step one is restrict the vision so they can build bandwidth there elsewhere. I would love to see them do some ideas like you're talking about, because again, the only way to really force it then is you can help on the rates, the programs, but you still got to have a house. So I think if you could get a program to try to entice, BlackRock or some of the big hedge funds to release some of those or slow down the iBuyers, it could help.
I see my friend Rob Krisman in the chat. He emerged from his Yellowstone binge watching that I know he's in the middle of, because he's texting me as he's going through it to note the heralded Swerbinsky plan that he jokingly coined it. But it would be nice to see something. And I think there are some things that could be done that make sense. But if not, man, it looks like a really challenged purchase market, especially, man, if 30-year fixed rates are in the high 3s or 4s. All the projections were that rates would be much lower than that, really, for most of this year. So we will see what happens. So
I will vote for Rich, just saying.
No, I want no part of any political office. So not even like city council. The Supreme Court, Mike, recently ruled. You guys are a big work from home company and have been years before the pandemic. I remember you leading sessions talking about it before work from home was even a thing. And but the Supreme Court officially nixed the vaccine mandate for companies with over 100 employees. And, just talking to a lot of our members, they were kind of saying, like, most of our people are remote. We don't want to put this in place. We hope that the Supreme Court rules this way. You guys had to be in that camp as well, right?
We were watching very closely. It's a hot topic, and I feel like that's a category that I know lots of other lenders were very closely watching that one as well. And I heard some very interesting creative ways that they were going to try to get around that legislation if it passed. So they're probably telling their attorneys, okay, I don't need 5 shell companies now to break up our company. So attorneys are probably less happy about it.
Lots of companies with 99 employees under one company, right?
I think there was going to be a lot of 99 company LLCs out there. Mm-hmm. So Rich Operation Services is probably not going to be a 99 employee company anymore. But it'll be interesting to see, because you see globally that more countries are starting to do even more restrictions related to the vaccinations. I was reading that some are starting to flat out fine people. So I don't think this will be the end of the attempts from the administration to try to put something in place, but I think this will be at least the end of that particular route of administration's attempt to force the vaccination.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by VIP Mortgage VP of Operations, Mike Metz. And Mike, a big acquisition in the mortgage industry, Redfin, a very well-known online real estate company, acquired Bay Equity. And there's been really, I guess, Cordray, CFPB, real estate owned mortgage companies really didn't exist at that point, nor did any start because of the RESPA related fears around that. And, once the administration changed hands to Republican, we saw almost all the real estate companies start mortgage companies. Keller Mortgage and Remax, I think, started Motto Mortgage, and all of them started something. We saw Zillow acquire MLOA out of Kansas City. That's kind of been a disaster for them. They never really got that off the runway to the extent they did.
Or
But
Zillow.
right, everybody feels horrible for them, I'm sure. So,
Mhm.
but Redfin, this seems like a pretty smart Backways, very well known out in your neck of the woods, out in the Southwest there. A little bit bigger than you guys. I think they did about 9 billion last year. But yeah, just would love your thoughts and your perspective on that acquisition. How you look at that as a key leader in the industry.
You know, what is really interesting about that one is, like you mentioned, Bay Equity did 8.5 bill. Most of the iBuyers that we've seen, I don't want to say we disregarded, but they've been making their own little mom and pop mortgage shops on them. And like you mentioned, they are big out here. So that's where I can authoritatively say the customer service from their attempts has not been stellar. So it has not been a concern on ours on the competitive front. This is an interesting route where they are buying an established company. Also, the numbers 135 for 8.5 in originations was wow. Um, but it does make me wonder how many more of these types of acquisitions we're going to see. I had already thought we were going to start seeing more mergers and acquisitions as we go into this next market. I think business owners who are kind of like, you know what, rode that last refi wave. Now's a pretty good time to float off into the sunset. We'll take a look at selling their companies and going through mergers. But if we see more from the tech sector, I think that'll be really interesting, especially combined with the fact that we've started to see some of the companies that were going more consumer direct saying, you know what, I don't think consumer direct's going to be as huge anymore, as they see the refis dry up and have to figure out more creative ways to do it. So I think this definitely won't be the last we see of a big tech company acquiring a larger mortgage company.
It is interesting, and as you noted, the numbers on it. I just know a lot of our members I've talked to. Same thing you just said: 135 mil, 8.5 billion in production. It's like in sports free agency, like when the first big domino falls. Like, okay, hey, all right, Fernando Tatis just got 310 million for 7 years, and all the other big name stars kind of, it starts to set a market. It'd be interesting to see how that plays out. I'm sure this is a deal that was obviously in the works for a long time, going into a declining market. But I know a lot of our IMB owners that are members took note of that for sure. And just because of
the calculators,
that there's going to be a lot of M&A. There's obviously a lot of interested buyers and sellers. They hit, M&A in the mortgage industry. It seems like that there's always a lot of one or the other, right? Like 3 winters ago when it was horrible, everybody wanted to sell, nobody wanted to buy. And, most of the last 2 years, there's, maybe a lot of people that wanted to buy, and people were just ringing the register on refis and like, I'm not selling. It seems like now there's interest on both sides, buying and selling. And how people that own companies value them, based somewhat off precedent, like we saw with the Redfin Equity thing, that will play a big part in it. But be interesting to see how it plays out. I still anticipate a lot of M&A this year, though.
Especially when you factor in how large the broker model started growing the past 2-3 years. And there are some excellent brokers out there, but I think there's also a lot of littler broker shops that started off with refis raining from the heavens, and they'll probably start to make moves now. And I think that'll probably spur it. I'll be interested to see how many end up with kind of joint ventures and partnerships, because you've seen some of the tech companies wanting to go that way. And like you mentioned, the real estate companies wanting to go that way. So it'll be fun to watch.
For sure. The private label security markets, not surprisingly, already we're starting to ramp up, kind of in the wake of the Calabria moves on non-owner and, the agencies now again under new FHFA leadership kind of saying, hey, this isn't really our mission statement. This really isn't our footprint. Raise the LLPAs on non-owner occupied properties and, conforming jumbo. Really starting to see, though, the private label security markets ramp up. And So and has that been your experience on that stuff that you guys can't sell to the agencies, that you're able to get better execution now through, better takeouts? Has that been your experience at VIP?
We've seen it kind of go cyclical with the market. Sometimes the non-QM space is super easy to work with, and sometimes it's all right, 35 days on a post-closing, not exactly a fun experience you want to go through. I think, especially the last year or two, after you saw the kind of liquidity crunch as COVID started, it became a lot more difficult. And I think at that point, there were so many loans, people were not focusing on those non-QM loans. So the non-QM companies were already, not really trying to go full bore on it yet. I think a lot of companies didn't care to investigate the non-QM space because they already had 34 cash out refis at a 400 loan amount to do. I think now you're going to see a lot more focus shift to that non-QM, especially as FHFA makes those moves. And I think as the market changes naturally, and all of a sudden, you mentioned the people where they've got 300 in equity in their home, and now you're going to have more affordability, which then means more creativity and the loan structuring that then also goes to that non-QM. I would not be surprised if you saw their market share double or triple this year.
I think this could be the year in classic mortgage industry. 2 springs ago, after the pandemic hit, like non-QM was done. Like lenders were folding up shop, and everybody was predicting this is, the end of non-QM. And a few months later, I was like, okay, maybe this isn't the end. And now it's, that's all you see and read and hear is this is the year non-QM. But at least to this, the last year and a half, you're right. I think you nailed it. Lenders are just too busy writing refis to give a crap about it. Before that, though, my read on non-QM was always like, the good non-QM loans, like typically you can go to a bank or a credit union and get them to put it in some portfolio product at better terms than what the non-QM secondary market would yield. But I think the secondary market has started to figure out there's some really good loans in here. And let's price it to compete with the banks and the credit unions that are going to put that loan on the shelves. And, the stuff on the fringes, let's at least be a little bit more transparent and a little quicker about what we won't and won't do, because we've just had so many members that you just kind of mentioned, like, the only looks we're getting on non-QM is the on the fringe stuff. And, it just takes forever to get feedback and not a lot of it ends up closing. But I think you're right. I think this could be the year that changes.
I think it will be. And I think all of a sudden people have to learn how to disclose ARMs again, because
right,
you've seen no one touching anything but fixed. And I think a lot of those non-QMs, they're going to want to start issuing, but they're probably going to want to get ARMs out there. And all of a sudden people are going to have to figure out how to do those again.
I was looking online today, just on a different project, at just some rate sheets of some investors, and ARM is starting to, 5-1 ARM, some creative, people forget about some of the creative ARM stuff that used to be out there, fully indexed, 1-year ARMs. And I know the bank I was at, we had a signature program. We created a 5-5 ARM that we just sold the crap out of against 30-year fix. Because if you do the cash flow on like the first 9.5 years, even if it goes up the max in year 5, still coming out so much better than the rate on a 30-year fix. So, it's the mortgage industry, just constant change. And I think that's going to be part of the change we see in 2022 is the return of the ARM. Do originators know how to sell ARMs anymore? Do they? It's been a while.
They're going to have to brush off the dust on some of those scripts. The funky part is they'll probably be going back to about 2006 for some of those scripts. And that's where I do cynically ask the question, okay, if we're starting to see lenders looking to set up relaxed lending guidelines to get tricky buyers in, ARMs, highly increasing rate environments and highly increasing home appreciation environments, does that remind you of any markets?
What could go wrong? We've
Yeah.
never seen that before, right? Oh, gotta love the mortgage industry.
Yep.
Along those lines of new emerging markets, we were going back and forth on email today. I've started to see some noise and smoke on just a market for standalone home equity loans and first lien HELOCs that I think I found 5 different lenders today just doing some due diligence. Couple that we're talking to, we're trying to find some alternatives for our members, IMBs like VIP and all these borrowers and customers you have that are sitting on 40-50% equity that, maybe want to put a room on their house, but don't want to touch that first mortgage. Would love the VIP mortgage to be able to do that loan, as opposed to them having to go to ABC Bank in Scottsdale. And starting to see a little bit that really has never, just at least in my experience being a former secondary guy, there's never really been outside of what emerged right before the meltdown. Rob and I were talking last Friday about National City here in Cleveland. Like they basically started a third party channel just buying seconds to like 120. And we know how that movie ended. But outside of the goofiness that preceded the meltdown, never really been a secondary market for standalone equity products.
I feel like that could be something that starts up. When you mentioned that, it started to make sense as I thought about it. Because as you said, I mean, one, with appreciating home prices and people sitting on 30-40% equity, they don't want to touch their 2% mortgage rate. HELOCs are going to make sense. And historically, you didn't want to do them in the past decade because, all right, you were looking at someone doing a $20,000, $30,000 HELOC, and you're going through all the work of that and all the compliance and regulatory risk of doing those HELOCs, especially if you're not familiar with them. But now if you add another zero onto those and you can package them up.
Yeah, you're right. The dynamics have changed. Homes are worth more. Values are up. And, you don't have to take even if you think that we're in a bubble, even if you just went to a max 80, you have protection there against home prices, decreasing or going down. So, the same way, I mean, I know banks and our bank and credit union members I'm talking to, like they view that as a big part of the opportunity of 2022. So, mostly in most cases, conservative banks and credit unions are willing to put that risk that way on their balance sheet. Why would the private market not? You hit on the reasons that they haven't to this point, right? It's a lot of work and you got to do draws and, you got to hire a team of people. I think hope technology can help now a little bit more with some of that, which will help, but there's just more of an opportunity, more dollars, more ways you can cross-sell in this day and age of tech. So we'll see how that unfolds. Something definitely we'll keep an eye on as we get into the year. So Mike, any other thoughts, comments, predictions, prognostications on the year that we have out in front of us here as we get into 2022? Any perspective of how you guys are looking at the market at VIP to take us home?
I still think it'll be a good year for our industry. I think it'll start getting tougher. And I think, to me, I look at the last 2 years as kind of ridiculous years. So you don't want to use those as a benchmark for business going forward. I don't think we're going to see anything like those for quite some time. I think you still have the rates increasing, but it's easy to lose sight. They're still way low rates. We're talking mid threes.
Mm-hmm.
That's a pretty low rate there still. And if people are still having problems with getting into the threes, then they should be taking a look at their economic situation and what they're looking to do there. So I still feel like there's going to be the residual refis that you always get in any market. You're still going to have the ones for people who want to get still into a threes and have more equity and do something with those. And you're still going to have that market where you're maxed out demand. So despite some of our earlier tone on this one being a lot of doom and gloom, I still don't think that it's going to be a bad year. I think you'll have things adjusting, and I think we'll see some interesting shakeups, but every time there is shakeups and things move, that's more opportunity available as well.
Very true. Yeah. It's, the highs and lows of any market create opportunities for good companies like you guys. I've seen you guys thrive through the winter of 2018 and the pandemic and the record volume. And good companies will more opportunity in volatile markets one way or the other. And love the optimistic note taking us home. And Mike, thanks for joining me. Always appreciate your perspective on the industry.
Glad to be here, and thanks for having me.
Absolutely. And to all our attendees, thanks for spending 30 minutes with us. We're here every week at 2 p.m. Eastern on Tuesdays with the Last Week in Mortgage Today. If you're not subscribed to the TMC Connect podcast on Apple or Spotify, that's where the majority of you listen. So I always like to mention that to our live audience. So until next week, have a great rest of the week, everyone. Take care, Mike.
Bye, everybody.